When it comes to trading Forex, most beginners focus almost entirely on price action candlesticks, support and resistance, indicators. But one of the most underrated tools in a trader's arsenal is volume. And today, I'm going to show you how to use it properly to understand market momentum, filter out false signals, and ultimately make smarter trades. Let's break it down. Volume in Forex isn't exactly the same as in the stock market. Because Forex is decentralized, we don't get a centralized volume count. What we get is tick volume, which reflects the number of price changes in a given period. While it might sound less reliable, studies and real-world trading prove that tick volume often correlates very well with actual traded volume. So, how do you interpret it? First technique, look at volume spikes during key market sessions. High volume during the London or New York session, especially during overlaps, often signals genuine moves. If you see a breakout during these times and it's backed by increased volume, that move is more likely to hold. Second, combine volume with price behavior. For instance, if price breaks a resistance level and volume is rising, it's a sign of strong bullish intent. But if volume is flat or falling, that breakout might be a fake out. The same goes for bearish breakdowns. Another powerful way to interpret volume is by observing volume divergence. If price is climbing but volume is declining, that's a red flag. It may mean the current trend is running out of steam. Savvy traders use this as a cue to tighten stop losses or even start looking for reversals. Now, here's where smart tools come in. Relying on volume alone can be noisy, but when combined with a reliable trend indicator, you get clarity. That's where something like the Apex Trend Indicator makes a real difference. It doesn't just show you trend direction with simple visual cues, it confirms it with non-repainting buy and sell signals, and overlays statistical success rates so you can see how likely a trade is to succeed. This is especially helpful when you notice rising volume, but aren't sure if the move is genuine. If the Apex Trend Indicator confirms the same direction with a solid win rate, you've got a double confirmation setup that's gold in Forex. Also, it's easy to scan multiple pairs and timeframes quickly with a trend scanner. Let's say you notice strong volume on a pair like GBP-JPY during the London Open. You check your scanner, and it shows a new uptrend signal with a 75% success rate. That's a trade worth considering. What's even better is being able to check entry and exit signals directly on the chart. Add in volume interpretation, and suddenly you're not just guessing, you're trading with confidence. In summary, volume tells you the strength behind a move, but when you mix that with accurate trend confirmation, you remove a lot of the guesswork. Whether you're using classic volume bars or a tick volume indicator, always cross-check with tools that give you a broader view of the market. Forex trading isn't about being right all the time, it's about stacking the odds in your favor. And if you can read volume correctly, combined with a high probability indicator like Apex, you're going to be ahead of most retail traders out there. So next time you open your charts, don't just watch price, watch volume. Look for the story behind the move, because when price and volume agree, that's when you strike. Thanks for watching FX Limit. If you found this helpful, give it a thumbs up and subscribe for more no-fluff, actionable Forex content. See you in the next one.